America is a powerful economic machine that since 1776 has worked, and it's going to keep working. Now, you don't want to buy to hold for a year. You don't want to buy with the idea that you could sell it in 2 years or 3 years, necessarily make money. You could lose money that way. But if you buy it for 10, 20, just keep buying the S&P 500 index.
Today we're going to be looking at how Warren Buffett, one of the greatest investors of all time, thinks most people should invest in the stock market, especially if you're a beginner and you're just starting out your investing journey. We're going to look at the investment strategy he recommends and see how it's performed over the long term. I'll also show you some interviews with the man himself to hear his own words on this strategy. And at the end of the video, I'll be showing you how easily you can follow this method by investing once a month from your phone. So without further ado, let's get into the video. Welcome back everyone, my name is Senan and this is Investing IQ. Now, Warren Buffett is widely known as the greatest investor of all time. The Oracle of Omaha has achieved a 20% annual return since 1965, an absolutely insane track record. And the strategy he recommends to most people, funny enough, is the opposite of what he does, which is to pick individual above average companies and try to beat the general market. The strategy he recommends is just to buy the general market.
On a composite basis, I'd bet on Berkshire over the market. That's assuming we're all dead.
I recommend it. I recommend the S&P 500 index fund, and have for a long time to people. And I've never recommended Berkshire to anybody. I wouldn't argue that the S&P 500 over time. I like Berkshire, but I think that a person who doesn't know anything about stocks at all and doesn't have any special feelings about Berkshire, I think they ought to buy the S&P 500 index.
And you never have to look at a news article or read a balance sheet. If we look at the stats in Australia over a 5-year period, 81% of actively managed funds failed to beat the ASX 200 index. And in the US, 75% of actively managed funds failed to beat the S&P 500 index. So passively investing in an index fund is a really popular strategy now, especially for everyday people who want to invest but they don't want to pick individual companies to invest in. The easiest way to invest in index funds is to buy shares of an ETF that copies the index exactly and is passively managed.
Yeah, I would say that in terms of the index fund, I would just take a very broad index. I would take the S&P 500 as long as I wasn't putting all my money in at one time. If I were going to put money into a index fund in relatively equal amounts over a 20 or 30-year period, I would pick a fund, and I know Vanguard has very low costs. I'm sure there are a whole bunch of others that do. I just haven't looked at the field.
Because most people can't afford to invest a massive lump sum like $50,000 or $100,000 all at once. But what we can do is invest a certain amount every month or every 3 months and build our wealth gradually. And this is known as dollar cost averaging. By dollar cost averaging, you take advantage of being able to buy more shares when the market is low, therefore lowering your average cost per share. And you get to reap the rewards of the long-term returns of the market with very little effort. All you need to do is set a timeline like every month or every 3 months or every 6 months and always invest the same amount every time. Next, I want to show you how periodically investing in an index fund would have performed over the long term using this strategy. And to do this, we're going to use a compound interest calculator. And if you guys want to have a play around with this calculator, I'll leave it in the description box below. Now, if we had $1,000 to invest, and we continue to invest $1,000 per month, and we invested into an index fund that on average got a return of 9% per year. Now, historically, the market on average has returned about 9% per year. If you followed that strategy for 25 years, you would come out with over $1 million. Just from turning up every month and buying shares of the index fund, no matter what the market is doing, whether it's up or down. And over the long term, you will actually outperform most professional investors with this strategy. The last thing I want to show you is how you can invest in an ETF that tracks an index. And you can set yourself up for the future by setting aside not even 10 minutes a month. So to do that, I'm going to jump on my brokerage platform. Okay, so we're here on Self-Wealth, which is the broker I use to buy Australian shares and ETFs. And all I'm doing is I'm simply turning up this month just to add to one of my ETFs, and I'm going to show you just how easy it is to dollar cost average into ETFs. Now, when it comes to choosing what index you want to track or what ETF you want to buy, you don't have to pick just one ETF to invest in. if you had $1,000 a month to invest, you could split it up and put 500 into 2 different ETFs, or you could put 250 into 4 different ETFs. And I personally split my passive investing portfolio between 2 different ETFs. So I have exposure to different markets around the world. So we're going to go to my portfolio. And these are the 2 ETFs that I have. So I have the BetaShares Asia Technology Tigers ETF, which tracks all the big tech stocks in Asia, specifically China and Taiwan. And the second ETF I have is the BetaShares Nasdaq 100 ETF, which tracks the Nasdaq 100 in America. So here's a little tip for you guys to save on brokerage fees. So hypothetically, if you had $1,000 a month to invest, the common way to do it is just to split 500 apiece between these 2 different ETFs. But the problem with that is you'll pay the $9.50 brokerage fee twice a month because you're making 2 trades. So what I do is, if I have $1,000 a month to invest, in month 1 I'll invest in the Technology Tigers. In month 2 I'll invest in the NDQ. In month 3 I'll invest in the Technology Tigers again, and you guys get the picture. So every month I'm only paying the $9.50 brokerage fee once. That's why this time I'm buying the Nasdaq 100 ETF. So this is it, guys. I'm just going to take you through the buying process just to show you how quick and easy it is. So we click buy. We triple check that this is the ETF we want. So yes, the BetaShares Nasdaq 100 ETF. And the first thing we want to do is change the price type to market, because a market order will just put the order through straight away at whatever the price is at that current time. The next thing we want is quantity. So if they're about $31 each and I have $550 to spend, I can roughly get about 15 units. Okay, so I have some extra leftover cash, so I think I can get 16. Yes. So I'm going to buy a quantity of 16 units at the market price, and that will cost $522, and then the $9.50 brokerage fee on top. So that will leave me with $29 left in my account. So I'm just going to triple check everything's correct. I'm buying the right ETF, I'm buying, not selling. Quantity of 16 shares at the market price. Okay, so that's all good. So we go to review order, and before you click buy, Self will just ask you what made you want to buy NDQ. So I'm just going to put aligning with target portfolio. So this is the last time you want to triple check again. So NDQ 16 at $31, estimated value $522. So that's all good. So we're just going to hit confirm order. So if we go back to my portfolio, we can see that that order has in fact gone through straight away, and I now own 16 more shares of NDQ. And that's it. That's all you have to do to invest in index funds and follow Warren Buffett's advice. And the reason Buffett says to periodically invest instead of one lump sum is very simple. Trying to time the market is very difficult. And if you only put a lump sum in once, you're essentially trying to time the market, and you may buy in at the wrong time and get lesser returns. Again, by dollar cost averaging, according to Buffett, we can take advantage of being able to buy more shares when the market is down and less shares when it's up. And buying more shares when the market is down and less shares when it's up over time will lower your average cost per share and increase your returns.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war, and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
If you've watched the video this far, thank you so much for watching. Your support on the channel lately has been crazy, and I can't thank you guys enough. If you're still not satisfied, I made a video of my top 5 Australian high growth ETFs for all you passive investors out there. And if you want to pick your own stocks, I made a full video where I laid out my entire research process from start to finish for how I pick my stocks. So I'll link both of them videos in the description box below. If you found this video useful, please consider subscribing to the channel. We just hit over 100 subscribers on the channel, and I'm so grateful to each and every one of you for all your support. If you guys ended up buying some shares in an ETF, let me know in the comments down below. As always guys, this video is not financial advice, it's just my opinion for entertainment purposes only. And always do your own research and come to your own conclusions before making any investment decisions. That's it for this video. Thank you guys so much for watching, and I'll see you guys in the next one.